got the rand very close to that 7 rand mark against the dollar, so some weakness filtering through there. But at the same time, the euro almost at 136 against the dollar, and that's a 6-week low again for the euro.
Yeah, good morning, Stephen. We really are starting to sound like a bit of a broken record here. It really remains a dollar play largely. We had some poor manufacturing data domestically yesterday, but I think the thrust of it is that the dollar has been on the recovery path, and as a result, the rand has started, to weaken. And I think it's probably going to breach that 7 rand handle to the top side. Key levels kind of 702. If it goes beyond that, we could be looking somewhere around the 718 in the coming weeks.
Do you see this as temporary strength for the dollar? Because the talk was of a weakening bias for the dollar going forward, particularly with more quantitative easing coming into the system.
Yeah, that was the initial reaction, but the first question you've got to ask yourself is how much of this quantitative easing has already been priced into the market, particularly those US Treasuries. They're extremely low, and we did see the yield curve in the States steepen up after the FOMC. So I think a lot of quantitative easing has been priced into short-end rates in the States. And then also we've got the re-emergence of those sovereign debt concerns in Europe. So that's bringing about some broad-based euro weakness. So possibly a lot of the QE priced in, and also just Europe has got some problems of its own.
So do you think we could see the euro weakening much further from these levels, given the height of the sovereign debt problems, and particularly with Ireland at this stage?
We do indeed, Stephen. We do. That's our base case scenario, that the dollar will continue to recover in the first and the second quarter of next year. So it might be the start of that kind of trend. I just want to add as well that the rand hasn't only just been weakening against the dollar. It's also been weakening against another number of other kind of emerging market currencies and commodity-based peers as well. And that ties up with some pretty hefty selling by these non-residents into our domestic bond market. And we know that a lot of the rand's strength over the past few months has been as a result of the strong capital inflows into our bond market in particular. And it seems as though people are starting to just take their foot off the gas a bit. And if those flows continue to reverse, and that could also be a catalyst for broad-based rand depreciation.
Well, Michael, how do you balance then the weakening trend we're seeing in the rand at the moment with those manufacturing figures out yesterday? Because the initial reaction to the manufacturing data was it's heightened the case for an interest rate cut next week, but at the same time we now have the rand weakening, which is obviously what they might want to do by cutting interest rates again.
Yeah, I think so, Stephen. I think that the effects of the weakening rand are still going to take time to obviously filter through into the manufacturing sector. It's still relatively strong. It's only the last few days that it's actually started to give back. But I agree with you. I think it does heighten the call for another interest rate cut, and that's our base case scenario. We are expecting 50 basis point cuts from the SARB next week, and the risk is that they actually cut by more. And if they had to cut by perhaps a full 100 basis points, we could see the rand weakening. I think even a 50 basis point cut on balance would be rand negative, because it not only reduces our interest rate differential, but it also reduces the sterilization costs which the Reserve Bank has to incur when it increases its reserve accumulation. So yes, I think that another interest rate cut would just add to our less constructive view on the rand.
Mike, of course, we have that G20 meeting wrapping up today in South Korea. Of course, I think they've agreed on what the problems are, but it doesn't look like they've come forward with any solutions at this point.
Well, Stephen, that's what we said early on in the week. We're thinking this is going to be more of a talk shop than sort of concrete measures being implemented. They've been working into the night, but I think it's very hard to believe that either China or the US are going to be forced into a corner either way. Every economy has got to try and deal with this crisis the best way they deem fit, and it's going to be hard to see any wholesale changes taking place from either of those two kind of heavyweights. So I think it's going to be more of the same. And we have to, do what we need to do in South Africa. We need to increase productivity. currency, and that way increase competitiveness. We also need a weaker rand. We can't rely on the Fed or the Chinese to basically come to our aid.